Let's revisit EGOLD. Let's look at back-tested moving averages, so the averages that worked best in the past. Let's look at the liquid supply curve. So where does new EGOLD hit the market in the future? Let's look at the inflation rate, and let's look at an approach, at a quantifiable approach of how to outperform just buying and holding EGOLD. Now we can look at EGOLD in several ways. We can just look at it in terms of US dollars or Tether. That's this chart over here. You've probably seen this time and time again, but we can also look at it relative to other smart contract platforms. How is EGOLD relatively performing? The idea of getting into something like Elrond is to outperform things like Bitcoin or Ethereum, right? You take on more risk, you want more performance. Risk and return has to be in some kind of a balance. This here is now EGOLD relative to Ethereum. You can see there is a somewhat long-term sidewards trading range where sometimes EGOLD is comparatively expensive and sometimes Ethereum is comparatively expensive. We have been in a bearish trend since November of last year, but we might be breaking out here now. This is interesting. Why have we been in this bearish trend? Probably because of the additional liquid supply that hit the market, right? Look at the liquid supply growth of EGOLD from 7.5 million in August of 2019 to currently 23 million almost, right? This additional supply needs to be digested by the market, by new buyers. And this then obviously also puts pressure on the price in relative valuation. But there is light at the end of the tunnel. The potential upside, if we reach higher market peaks, is around 150%. The potential downside is roughly 66% if we return back to this bearish trend. Now, there are layer 1 competitors that are even more inflationary. AVAX, for example, it's got an annual inflation rate of more than 20%. EGOLD currently has an annual inflation rate of 14%. So we can see how this inflation differential really does have an impact on price. EGOLD tends now to outperform AVAX. There is a relatively solid support and we haven't yet reached the higher levels. For completeness sake, let's also look at relative valuations to Solana, Phantom, Harmony One, Cardano and DOT. So let's do this relatively quickly because I want to go to the back test afterwards, to trading EGOLD actually, to perform better than just buying and holding. But first things first, relative valuation of EGOLD to Solana. It's in a relative solid support range, which is also relatively tight, right? The potential downside is 33%. The potential upside is up to your fantasy, right? Who knows if you can find these kinds of elevated prices again in the future. That would be like more than a 10x, 1300%. Currently, EGOLD and Solana are somewhat trading in tandem. EGOLD relative to Phantom is outperforming, which does make sense. Phantom is pretty much a dying ecosystem. There aren't a lot of new decentralized apps being deployed. The ones that are running are also dying, right? Tomb Finance, etc. lost its pack. So this is no surprise to me, and I would not be surprised also if EGOLD continues to outperform Phantom. If you've currently got a large stack of Phantom, I do think it might make sense to switch this to another layer 1 competitor. This is EGOLD versus Harmony One. Also, the recent past outperforming EGOLD versus Cardano. It's interesting how a lot of these charts show relatively constant trading ranges, right? Look at EGOLD versus Cardano and EGOLD versus Ethereum. We do have our lows and our highs, and we tend to revert once we are at these extreme levels. EGOLD versus Cardano is no different. And the ranges in terms of percentage change are pretty massive, right? This is a more than 80% drop from top to bottom, or if you measure it the other way around, a more than 5x. So it does make sense to shift altcoins from one heavyweight position to the next. You do want to be somewhat counter-cyclical. If everybody is excited about EGOLD, you rather want to get out. If everybody is excited about Cardano, you rather want to get out. And you want to switch back and forth and ride those waves. Last but not least, EGOLD relative to Polkadot, also pretty interesting. We do have a breakout out of this bull flag. So classical TA, even though these kinds of moves aren't too reliable, classical TA would say that EGOLD tends to go up from here. Now let's look at something that I think is more reliable, and that's back-tested moving averages. So let's go back to the US dollar denominated chart of EGOLD. And let's actually start off with the red line. So this one over here. The idea of trading according to moving averages is that you want to be in the market, you want to bet on rising prices when the price is above the moving average, right? So you would be buying EGOLD over here and you would be holding it all the way. You would be quickly selling it here in order to then just rebuy again. Here you also have a bit of a missed trade, but you would basically ride this wave over here, this 2000% gain. And then you would be exiting. You would not be in the market during these times, right? Where we drop 50%, you then quickly buy and sell again for pretty much the same price, and you spare yourself from this 50% loss. And then again, you get into the market when the price is above the moving average, and you ride this 4x or 300% gain. Okay, that's the idea. Now, in general, this works pretty well for a lot of cryptocurrencies. And currently, by the way, for this particular moving average, we are again above. Saying that we have to go up from here, right? We do have our failed signals where we cross above and then below again. But that's why we want to make back tests. Now, what do we want to back test? Let's just take a moving average, a random moving average, and let's play around with this a little bit. You can over here change the duration of the moving average. You can say, I only want to average out the last 20 days of price movements and trade a bit more frequently. Or you say, I want to average out more days, thus making this line a little bit smoother and thus also generating less trading signals, right? When you've got a moving average of say 100, your line is pretty far away from the price and you wouldn't go in and out of it all the time. But it also means that you're relatively slow in reaction, right? When we are dropping, you might only bet on falling prices or you might only sell into cash once we have already fallen 36%. And the same is true the other way around, right? When we are getting bullish, you might wait until we have already gained 63% until you actually buy in. So you want to be a bit shorter on the time frame than 100 days. But when you go too short here, right? When you then reduce the length to say only 3 days, right? And then you zoom in over here, you would be buying and selling all the time, incurring trading fees. So our backtest should regard trading fees. It should look at trading fees. It should also, when taking that into account, measure what's the best duration. So we want to simulate buying and selling based on different moving averages. We can do this for the exponential moving average as we have over here. We can also do this for the simple moving average. Those are slightly two different moving averages. Simple moving average just looks at the different prices in the past and weights them equally. The exponential moving average has a bit of a recency bias. So it would take the weight of the recent prices a bit more into account. So let's say here, as an example, we take the 100-day EMA and let's also look at a simple moving average and also take 100-day. Then you will see the difference here. You see that the EMA tends to be a bit closer to the price than the SMA, right? The SMA is a bit slower to react. You would be buying a bit slower. When we cross from below to above the moving average, you would also be potentially selling a bit later. So that's the difference between those two kinds of moving averages. So we want to find out what kind of moving average works the best, EMA or SMA, and then what kind of duration is the best. When you optimize this, actually, you get very interesting results. This is an Excel sheet that I've prepared roughly half a year ago. So it doesn't have too much recency bias. We are looking at data that ends on the 16th of April of this year. So this is no overfitting, just looking at what happened yesterday. And in this Excel sheet, which you can, by the way, download here at thebitcoinstrategy.com, the premium membership, you can then run this back test. So let's say we go both long when the price is above the moving average, and we also bet on falling prices when we're crossing here below, right? So let's say we go below those moving averages. We want to make money when this price is going down. So we enter a short position. We make money when prices fall. So we do both of this. We bet on rising prices and on falling prices. And we've got an initial capital of 10,000 US. And let's then iterate over the different simple and exponential moving averages. So this is a macro enabled Excel sheet. So I can simply just click on this and now the program does its magic in the background. What we see over here first is the buy and hold performance. So you would have gotten 490% from the beginning of the time series to the end. So that's annualized, 490% per annum. And now here, while this is flickering back and forth, we can see the best performance according to different moving average durations. So now this calculation is done. We can see for the simple moving average, it's even the 4K that worked the best. So pretty small duration. And then for the exponential moving average, we also have the 4-day. That's pretty good. But let's look at something that's maybe a bit longer in duration to have a counterweight. 52 seems to be okay. 40 also seems to be okay. Let's take the 40, okay? 40-day exponential moving average. And then once we do this, we can actually look at this also in chart form. Here in black is buying and holding, right? Roughly 500% per annum. And then we can see trading according to those moving averages pretty much always outperformed just buying and holding. You really have to be picking the wrong durations in order to underperform buying and holding. And this is including trading fees. So I'm looking here at 0.1% trading fee. So for each purchase and for each sale, 0.1%. And still, even if you have all these fees included, timing the market pretty much with any kind of moving average is better than just buying and holding, simply because of the high volatility of EGOLD. So if we now plot these charts, we look at the 4-day simple moving average. Let's take that. And for the exponential moving average, let's take the 4-day. Okay, so when we change here the moving average indicator over here, best moving average, best exponential, this is what we get. Now, why do I have these best simple moving average indicators over here? It's because there is actually a script, again, on the premium membership, where you can download the code of all of this. So you have here the different kinds of assets that I've backtested, and you can simply just copy paste this into TradingView. And then no matter what asset you look at, you will see what historically worked the best. So we can see these 4-day moving averages, they do create quite a bit of noise, right? You buy and sell all the time. So if you do consider actually executing this, I would probably use a bot to do this. By the way, all of these trading strategies, they only look at the end of day price, right? UTC time zone. So we're only buying or selling when the price is above or below at the end of the day. We are not concerned about the movements within the day, okay? Otherwise, there would be simply too many trading signals. So currently we are above. So that's at least for the EMA if you don't trade too often. How well does this actually work? Again, these are annualized performances. Let's not look at the hyperactive SMA. Let's look at the exponential moving average that didn't perform as well, but that also doesn't need automation. So over here, we've got the EMA performance, 40-day, and in white we see buying and holding, and in red we see the exponential moving average performance, right? We either simply just track the value, we are bullish and we time this right. During sideways movements we also go pretty much sideways. Then if we have an extended crash, we also tend to make money from this, leading us to quite a bit of a difference, right? If we started with 10K, you bought and held Elrond until today, you would have now 176K. But with this strategy, you would be at roughly $1 million. So quite a delta. And this kind of an effect, right? The effect that most moving average trading outperforms just buying and holding can be observed for many cryptocurrencies. Not for all, but I would say for probably 70 to 80% of cryptocurrencies. If you time them right and you use backtested moving averages, you can outperform just buying and holding. And so all of this isn't even discussing now the fundamentals of Elrond, right? This can be used for any cryptocurrency, and we're simply just looking at the data. We simply just look at what historically would have been a nice quantifiable approach. So does it make sense to buy Elrond now? Obviously, it all depends also on the overhang of the macroeconomy, right, where interest rates are rising and pretty much everything is now getting depressed. But if we just look at relative performance to other cryptocurrencies, Elrond doesn't look too bad. If we look at the backtested moving averages, Elrond doesn't look too bad. So if you are considering getting into any kind of crypto right now, even though things don't look that bullish macro-wise, if you are considering to hold anything, then Elrond doesn't seem to be the worst bet. One thing to note though, in case you haven't yet, be aware of 2 more supply unlocks for the team, okay? So over here in Messari.io, we've got a treasury reserve and a founders and team unlock, and currently we are in the middle of October of 2022, but there will be an unlock at the end of the year, right? So when we go from 22 to 23, and then another unlock in the middle of 2023. So if you want to time this short term, you might want to have a look at this. These additional supply increases could very much depress the price. So make sure you keep an eye on this, and if you are actively trading, to maybe be outside of the market a few days after the unlock, or basically sell before and then stay out for maybe a week or so until everybody that got their tokens here has sold. One last shameless plug for the premium membership. Thanks for watching. Feel free to check it out. It's $75 US per month. If you sign up yearly, you do get 2 months for free. There's more information in this video over here. Hope to see you in that video, and thanks for watching this one. Bye bye.